Let's take a moment, look at the disclaimer. This content is for educational, informational, and entertainment purposes only, and nothing should be taken as a recommendation to buy, sell, or hold any securities at any time. We're here just to spread the word of how BTA analyze the market, how we look at the market. This is Rod from BTA, and we are known as the Middle Traders. Okay, this is going to be our weekly walk with the market. Our weekly walk with the market. As y'all know, we have to stay in step with the market. We got to walk with the market. Okay, if you could get the direction of the major market indexes, the actual indexes themselves, if you could get the direction of the indexes right, if you could get it right, then you have the highest probability of success, because 75% of all the stocks within the indexes are going to follow the major market indexes direction. 75%. So don't you want to be in that 75%? Why try to find the 25%? Why go against the direction of the major market indexes and try to find the 25%? When all you got to do is walk with the market. Okay. This is our index comparison workspace that we're looking at here. We have the Dow Jones, the actual index up top. In the middle, we have the chart of the Standard & Poor's. And at the bottom, we have the Nasdaq Composite. So let's start out with the Dow Jones Industrial Average, the actual index itself. Okay. Look how the index this week found support right at the 30,635 level and the 30,504 level. Okay. This week we found support there. Well, specifically, we found support Thursday and Friday. We had to sell off this week. We traded down. Okay. Because this is a daily chart of the Dow Jones Industrial Average. This is a daily chart of the Dow Jones Industrial Average, right? So we can see we traded down to these support levels this week. Okay, Thursday and Friday we really tested it and we bounced. Okay, so Thursday we tested it and it traded back up, and then Friday we tested it again, and the index traded back up. Let's zoom in so you can make sure you can see this. Okay, 1 second. Let's zoom in right here, and let's move this up a little bit. You see, Thursday and Friday, we tested these support levels, the 30,635 and the 30,504. We closed at 31,097. Okay, but we traded right down to the support level for 2 days, tested a little bit below it, and we bounced and closed above it. On Thursday, came right back Friday, tested it, bounced and closed above it. So now what we have to see is, can we get above this upward trending trend line right here? Can we get above this upward trending trend line? Going back to the March 2020 lows is where this trend line starts. It's going right across here. Okay, can we get above that? And also, we got this 31,255 level right here. This horizontal resistance level right here. So this is the level that we're looking for next week. Okay, remember, Monday is a holiday for the 4th. So the market is closed on Monday. Trading will start on Tuesday. Okay, but this is the level, the 31,255 level for the Dow Jones Industrial Average. Right at that level, we also have this internal upward trending trend line. So we got to get above that horizontal support resistance level. I'm sorry. If I said support, please forgive me. That was prior support. Now this is the overhead resistance level right here at 31,255. I'm sorry. If I said support, it was prior support. Now it's acting as resistance as the market try to run back up. So it's the overhead resistance at 31,255 level with this upward trending trend line, this internal trend line coming all the way back from the March 2020 lows. So that's the level we're looking at right here. The overhead resistance 31,255. Let's see what happened next week with the Dow Jones Industrial Average. Okay, now it's also a fractal. This fractal at that 31,000. Remember, that's the low from the first double bottom that we formed a while ago, and then we broke above that, and then we went into that consolidation area. So this 31,255 resistance area that I'm talking about, okay, it is the previous fractal from the first double bottom over here. All right, so that's a strong level because the last time we broke above that, we went up here and we tested this middle high, the middle point of the double bottom pattern. We broke out of this here downward trending channel that price was stuck in, but we ran up and got consolidation, and then it collapsed. So let's see if we can get back above that level. All right, and this trend line, like I said, that internal trend line is coming all the way back from the March 2020 lows. All right, so now let's take a look at the Standard & Poor's 500, the actual index itself. And what's interesting about the Standard & Poor's, that 3,800 level is the level. Okay, that's the level for the Standard & Poor's 500. We mentioned it pretty much all late last week. We kept talking about the 3,800 level. Okay, if we break back below the 3,800 level, that can be an issue. Well, we got below it for one day, and then it got right back above it. So look right here. This is the horizontal line, which was prior support, but now it's acting as resistance. That's the 3,800 level that we're talking about, right? That's the 3,800 level. You see it right here. That's the 3,800 level. That's what was acting as support, but now we needed to, and then it started acting as resistance. Now we want to see if we can stay above it and let it transition back to support. Let's see if we can stay above it. But this is the level that the market is fluctuating above and below. This 3,800 level is key. Okay, this 3,800 level is key. Now, let's see if the market could trade above that, right? But now look at this. This is important. If we get above the 3,800 level, right? We get above the 3,800 level, we got this internal trend line right here that's going all the way back to the March 2020 lows. So we could stay above the 3,800 level, see if we get above this internal trend line. And then we'll come up, the next area of interest is this next internal trend line coming all the way back from the March 2020 lows. We get above that, now you're right at the 3,900 level. We get above 3,900, well, the next level would be the 4110 level, and that would be the previous consolidation that we was in for about 10 or 15 days a couple of weeks ago before it broke down. So you see what's happening here. We got a lot of overhead resistance that we got to get through. But the first thing we have to see is, can we stay above this 3,800 level? Are we going to break that support level and head back down to here? Okay. Well, that's yet to be seen. All right. But we have to see if we can stay above the 3,800 level. Is the level for the Standard & Poor's 500. And then let's see if it doesn't break down and test these prior lows. If it doesn't break down and do that, and it stay above these trend lines, and break back above the trend line and stay above it, and we get back above this 3,900, well, this is the consolidation area we made it to a couple of weeks ago, and we couldn't get above that. That's where we got rejected at the 50-day, the 21-day, and all of that, and it got rejected there, and it collapsed. Okay, so that's the area for the Standard & Poor's 500, 3,800. That's the level. Okay, so now let's look at the Nasdaq Composite. Let's see what the Nasdaq is trying to tell us. Well, the level we talked about all last week, pretty much the 11,000 level. Well, late last week we talked about the 11,000 level. It was prior support, turned resistance, back to support, turned back to resistance. Now it need to act as support because price broke above it on Friday. Okay, we tested it and we had pretty much a unchanged day. Some people like to call it a doji for those who like to look at the candlestick charts. But we had a day where prices opened up, traded back down, and closed pretty much even. All right, it was pretty much unchanged for Thursday. And the area that it was unchanged at, that area that it ended up where it opened that and closed that unchanged after all that upward and down price fluctuations, all that volatility, it stopped right back at the 11,000 level, 11,035. That's exactly where it stopped at. And remember, this is our fractals right here from that previous double bottom that we was in, okay, before we broke out and got into the consolidation. Same thing like the Standard & Poor, okay, the 3,800 level is the level for the Standard & Poor. The 11,035 level is the level for the Nasdaq, okay. That's the price level, that's the level that price has been fluctuating and trying to find either support or resistance, either going to break it at support and trade down, or we're trying to get above that resistance and go back up and try to see if we get back up in this area, okay? But the first thing we had to do is stay above this 11,035 level, get back above this internal trend line right here, get back above the other internal trend line right here. Both of these trend lines are going all the way back to the March 2020 lows across these recent fractals, okay? If we could get above that, find some support, and then try to get back up to the 11,900 level where we got consolidation before, and then let's see what happened. How will it react when it gets there? But we have some key moving averages that we got to get through in order to get there. First things first, keep support. Try not to go back below the 11,035 level. Hold these internal trend lines right here and see if we can move back up from there. But we got some key moving averages that we have to get through along with these resistance levels on the structural chart. So that's the Nasdaq. Okay, so those are the key levels we're going to be watching next week for the Dow Jones, the Standard & Poor 500, and the Nasdaq itself. Remember, the major market index ETFs that we track, they track these major market indexes. They're tracking the major market indexes. If the major market indexes are going up, the ETFs are going up, not the other way around. The indexes don't track the ETFs. The ETFs tracks the major market index. So you have to know your levels on the actual indexes themselves. That's why we go through this every weekend. I will walk with the market, and every day we watch these levels on the actual indexes themselves. Because if they're breaking their levels and they're starting to break out and get into a trend, whether up or down, then the ETFs that track them are going to do pretty much the same thing. They track the indexes, so you got to watch the indexes. Are you picking up what I'm dropping down? Are you picking up the jewels that I'm dropping right here? The ETFs tracks the indexes. You got to watch the indexes. Okay? Now, let's look at the moving averages for the major market indexes, okay? We know the structural levels that we got to get above, but remember I just said we got some key moving averages that we got to get above in order to break through all those structural levels, okay? The key moving averages. Well, here's the Dow Jones Industrial Average with our moving average, the actual index itself. You see here, we got this downward trending 21-day moving average. It's right overhead at 31,280 for the Dow Jones Industrial Average. It's a daily chart of the Dow Jones Industrial Average. That 21-day moving average is it. Okay, we did get back above the 5-day moving average, which is the white line, and the 9-day moving average, which is the green. We did get back above that. That's great. But now we got the Dow Jones, we got the 21-day moving average right overhead. And then on top of that, we got the 50-day moving average. Remember, the 50-day moving average is what held resistance when we got into this consolidation phase right here, okay? The 21-day moving average held resistance. Now, I'm sorry, the 50-day moving average, I apologize. The 50-day moving average held at resistance, and the 21-day moving average held at support while we was consolidating right here. But you see that overhead 50-day moving average? It held this consolidation area as resistance, and then we collapsed, broke back below the 21-day, and it was downhill from there. Okay, so right now we're testing the 21-day moving average as overhead resistance again. We break above that, we just got to watch this downward trending red 50-day moving average. That's it right there. So first things first, can we get back above this overhead resistance of the 21-day moving average? Okay. Now notice that Friday was an up day. It traded up Friday after a lot of volatility, up and down movement. But what was the volume doing? The volume was lower than the previous day. Okay, the volume was lower than the previous day. So when you're getting a rally trying to move upward on low volume, that's not really convincing. And look what happened on an unchanged day on Thursday. When it was unchanged and it was a down day, the volume was higher. On the up day, you got below average volume and lower volume. Okay, you just want to see on days when the market is going up, it's nice to see the volume coming in. Okay, because the volume coming in is a sign that institutional investors are buying this thing. But if you get an up day and you got low volume, there's no buying there. There's no institutional sponsorship going on there. Okay, so this is not really that convincing. An up day on Friday with low volume. It's not really that convincing. Now, you got to ignore this big volume bar here because remember that was doing with our option expiration, the rebalancing of the Russell 2000. So that was an anomaly. So we got to ignore that. It was on a follow through day also. We got to ignore that heavy volume there. But look, another key thing we got to remember is prices undercut the low of the follow through day. We already undercut the low of the follow through day. We undercut it, we got back above it. But when you undercut the low of the follow through day, you got pretty much a 90% chance of failure. Okay, the most recent data is saying it's a 90% chance of failure, and we would the rally attempt would fail. Well, what does that mean when the rally attempt would fail? That means we go back and undercut the low of the first day rally attempt. So this is our follow through day. This is our first day rally attempt. Okay, so basically it's saying there's a 90% chance that prices are going to come back down. It's a 90% chance that the price is going to come back down to somewhere around this level, undercut this low of the first day rally attempt. So when you undercut the low of follow through day, it's pretty much the most recent data saying it's a 90% chance of failure. It definitely has a 70, 80% chance of failure for all the historical data saying that. Okay, so 70, 80% chance of failure is right there. The failure for the rally, meaning that we may come back down and undercut the low of the first day rally attempt. So that's the Dow Jones. All right, now let's look at the Standard & Poor's 500. Okay, actual index itself. Look at the Standard & Poor's 500. Okay, the Dow was above the 5 and the 9. Okay, the Standard & Poor's 500. Okay, is closing right at the 5-day and the 9-day moving average. Okay, look at the Standard & Poor's 500. Look where we closed at. Right below and just a little bit above, right below the 5-day, the white line, which is the 5-day moving average, and just a little bit below. Right a little bit below the 5-day moving average, and just a little bit above the 9-day moving average. My goodness, okay? Just a little bit above it, just a little bit above the 9-day. But pretty much we closed right at the 5 and the 9, okay? But this is the issue, this downward trending 21-day moving average. You see it acted as resistance for 2 days over the last week and a half. This downward trending yellow 21-day moving average is what we got to look out for. This overhead downward trending 21-day moving average, and then we'll have the overhead downward trending 50-day moving average, the red line right there. So we got to watch out for that. But remember here, another up day on low volume. Another up day on low volume. We don't want to see that. Okay, up days on low volume, not good. No institutional sponsorship there. Okay, now look, the same thing. This is our follow through day right here. This is our follow through day right here. This is the low of the follow through day. You see, we undercut it. We undercut the low of the follow through day. Okay, so pretty much 70, 80, 90% chance of failure. High probability of failure. What is the failure? That you come back down and trade back below the low of the first day rally attempt. Okay, that low of the first day rally attempt. Okay, that low of the first day rally attempt, just to put some numbers on it for the Standard & Poor's. Okay, that's not totally accurate, but it's close. at 3,634. Right now we at 3,800. It's a possibility we could trade back down to 3,600. That's 200 more points to the downside from where we at right now. It's a 70, 80, 90% chance that that's going to happen. The probabilities are not in our favor. Hey, the 10% chance might make it. Okay, it's a 10% chance it could go on a rally and give us a nice, strong rally, tradable rally, or the start of a new bull market. It's a 10% chance. But it's a 70 to 80 to 90% chance that it's not. And that is going to trade down to around 3,600. Well, let's see what happens. But I will be keeping my eye on this very closely. And I'm not going to get too courageous just because the markets start going up. I'm going to go in very slow because I know it's only a 10% chance that is going to succeed. Okay? Be careful. Be careful. Math does not lie. Men lie, women lie. Numbers don't. You got it? That's a nod to Jay-Z. Men lie, women lie. Numbers don't lie. Be careful. Okay? Here, now let's take a look at the Nasdaq Composite. See what our moving average is telling us for the Nasdaq Composite. Okay? Same thing. The Nasdaq Composite itself is trading now below the 5 and the 9-day moving average. Now, what do we say about a index or stock or anything that's trading below the 5 and the 9-day moving average? Is nothing to talk about. Okay, I can't be long this when we got a 5-day, this white line, 5-day moving average, which is turning down. Okay, and we got a 9-day moving average that's just right below it. Well, trying to get back above it. Okay, the 5 just crossed below the 9. Okay, that's just not good. Not good action from the moving average. The 5 is crossing below the 9. Prices is below the 5 and the 9. And then you got the overhead 21-day moving average that's trending down. Not good. We had another update on low volume. Not good. Okay, not good. So you can see that the Nasdaq Composite does not have a really good looking chart if you're trying to go long. No good. So we in the rally. The rally is under pressure. Point blank and period. Let's just get that out the way. The rally from our first day rally attempt and our follow through days on all of the indexes are in trouble. Let's just get that out the way. It is under pressure. It is under pressure now. And it's a 90% chance that it's going to fail. Here's our follow through day. The first unconfirmed follow through day, unverified follow through day was here. Then we had the next follow through day right here. But what happened? We have undercut the low of both follow through days, right? No good. 90% chance of failure. So you know you got a 70, 80, 90% chance of failing, that the Nasdaq could come all the way back down to this level, okay? Somewhere around the 10,600 level. We at 11,127 right now. That's a pretty good push back down to these lows. But history is telling us it got a strong probability that that can happen. So the market has to prove itself to me before I go long, and starting there with getting above its 21-day moving averages. Factual. Starting to get above, it has to start to get above those weekly levels on our end of day analysis from Friday, the first. Go back and look at the video. Our part 2, the weekly analysis, okay? The weekly levels. We have key weekly levels that we got to get above. And you see these daily levels on those indexes, the major market indexes themselves from part 1 from yesterday. And now you see the levels on the actual index itself. Be careful. The Nasdaq was up yesterday on Friday on low volume. Look at the down days when the market was trading down. Look at the distribution coming in. Higher volume than the previous days and above average volume. Ignore this. This has had to do a lot with rebalancing the option expirations here and here. That doesn't count, okay? That we got to ignore those big anomalies. Other than that, do you see a whole lot of that above average green bars on these volume bars? Okay, enough said. You see the distribution coming in, and you see our line analysis of the on-balance volume and accumulation distribution line. It's just not there, okay? Now we're going to look at the IWM. This is the last one we look at for our moving average. Look at the IWM right here, okay? You see the IWM got the same picture, all right? We're right at the 5 and the 9. The 5-day moving average is the white line. The 9-day moving average is the green line. We're right at it at 171.41, okay? For the Russell 2000, the IWM, the ETF that tracks the Russell 2000. Look at the 21-day moving average right overhead. A downward trend in 21-day moving average is right at 174 right now. Okay, so you got to get above the 5 and the 9. Then you got this downward trend in 21-day moving average you got to look out for. And then over top is the downward trend in 50-day moving average that held that resistance before, and then we collapsed. A lot of overhead resistance that we've been trading up to in this here bear market, okay? We've been getting these little rallies, okay? We've been getting these little rallies within the relief rallies within the overall bear market, but they've been pausing right at the 21 days and the 50-day moving averages. Be careful. Same thing with the volume. Friday was an up day, but we still got held right at the 5 and the 9, but look at the volume was low on the up day. No accumulation there, no institutional buying. It's just an up day, all right? It's an up day on light volume right before a holiday weekend. Doesn't mean anything. Be careful. We got a lot of overhead resistance, there. We see the structural charts. Now we see the moving averages. Be careful, okay? Don't get caught and don't get your head handed to you, all right? Let's look at the guppies. Let's look at the guppies real quick. It's not much to talk about. You see the Dow Jones Industrial Average. You see what the guppies looking like for the Dow Jones Industrial Average. Look at the magenta line of closing prices. Look at the magenta line of closing prices. You see it. The magenta line of closing prices is trying to get above the faster, shorter-term green moving averages. Now, notice how the faster, shorter-term green moving averages are squeezing together. Okay, you see they're squeezing together, they're consolidating. That's showing us consolidation right there. That price is not really going anywhere. The shorter-term, faster green moving averages are squeezing together, and the magenta line of closing prices are right inside of there. And overhead, you got the downward trending, longer-term, red moving averages. Look how they spaced out and and fan into the downside. The guppy is telling you that the Dow Jones Industrial Average is clearly, right in your face, still in a downtrend. The momentum, the acceleration, everything is to the downside. The magenta line of closing prices is stuck within the faster, shorter-term green moving averages. Look at the Standard & Poor's 500. Look at the Standard & Poor's 500. Same picture, okay? Look how the guppy, the magenta line of closing prices, are stuck within the faster, shorter-term green moving averages. You see it right here. See where the magenta line of closing prices are at? Stuck right inside the shorter-term green moving averages, all right? And the longer-term, slower red moving averages are pointing straight to the downside, and they are fanning out and separating from each other. The long-term trend is clearly down, and with momentum and acceleration to the downside constantly, okay? But right now, the magenta line of closing prices is stuck within the shorter-term, faster green moving averages that is consolidating sideways. It's tightening up. It's squeezing right there. Okay, so the Standard & Poor's is clearly still stuck within a downtrend. We gotta take it for what it is. We are in a downtrend. The trend is down. The trend is down. The guppy is telling you that. There's no need to fight that. Make it prove itself. The last time we got above the shorter term green moving averages, what happened? We got right into the longer term, slower red moving averages up here, consolidated, and it collapsed. So even if we get above these, we gotta, before you start getting too courageous, you gotta see if you can get above these longer term, slower red moving averages. So even if we get above that, get back above some of those key moving averages, okay? Get back above some of those key structural support and resistance and trend line areas, okay? We start getting back above all of that, we still know that we're going to be coming into some serious overhead resistance with these longer term, slower red moving averages on the guppy. Now let's look at the QQQs, and you can see, this is the Nasdaq, okay? Not the QQQs, all right? The Nasdaq. The Qs track the Nasdaq, specifically the Nasdaq 100. But here, this is the Nasdaq Composite itself, because we're doing our walk with the market. So we analyzing the actual index itself, and look at it. The magenta line of closing prices is still, for the Nasdaq, it hasn't even gotten inside of the green, shorter term, faster moving averages. We're still stuck below it. Look at the longer term red moving averages pointing straight down with a lot of separation, fanning out to the downside. The long term trend, everything is down for the Nasdaq Composite. So, in summary, everything is down. We below key moving averages, okay? We below the 5 and the 9. The 21 days acting as overhead resistance for all of it, all right? For all of the major indexes. We undercut the low of the follow through day. We got distribution. I forgot to mention that. We got distribution within 2 days of a follow through day. You see right here, if you look at the Nasdaq Composite right here, we had the follow through day on this day. Within first 1 day afterwards, second day afterwards, we had a down day with higher volume than the previous day. So we had distribution within 2 days. If you start getting distribution within 2 to 3 days of the follow-through day, right there got a 50% chance of failure. And then you start undercutting the low of the follow-through day, you kicks it up to 90%. So look right here for the Standard & Poor's. We had the follow-through day. 1, 2 days later, we had a down day with higher volume than the previous day, distribution. Same thing for the Nasdaq. We had our follow-through day. 1 day, 2 days later, we had a down day with higher volume than the previous day, distribution. So you see we got distribution on all the indexes. We got undercutting the low of the follow-through days on all of the indexes. We had the 21-day downward trend and 21-day moving average. We right below or right at the 5 and the 9-day moving averages. We below the guppies. The guppies we stuck within was either below or inside of the shorter term greener, shorter term moving averages. You see it. So no matter what you hear from anybody could call themselves some kind of professional on the news, on TV, anybody anywhere on the internet talking about buy the dip, I suggest you go back and look at this video, because men lie, women lie, but the numbers in the charts don't. This is not financial advice. But wouldn't it be wonderful if it was? Wouldn't it be great if it was? But it's not. But if it was, you definitely would not lose a lot of money. This is part 1 of Walking with the Market. I see you in part 2. See you in the next video.